Hi everyone, Billy here from My Dad the Trader, and today I want to talk to you about probably one of the most important lessons that I can ever teach you. And in fact, it's so important that I recommend you learn this even well before you place your very first trade. It's got to do with how do you protect your trading capital. Now, as a trader, you'll recognize that your trading capital is by far the most important thing that you have going for you. Because once it's done, it's not so easy to get back into the game. The most important lesson that I can teach you is just how to make sure that your capital does not disappear right in front of your eyes. Now, when asking people what is the most important thing that prevents them from trading, the answer that 9 times out of 10 pops up is that everybody is scared about losing their money. Trading is not something that you can, as a start, say, I'm definitely going to make a ton of money. There's no risk involved. It's a sure win transaction. Trading comes with its own set of risks. And the point being that when you start out trading, it's this almost inertia that you experience because you don't know what to do. You don't know what to risk, what to do, what trading strategies to use, how much do you commit to a trade of your capital. And more importantly, what happens when your capital is gone. So I really cannot overemphasize the importance of what I'm about to show you. So the 3 biggest risks would be you don't ever want to expose your trading capital to one big market event. So if a market blows out, you don't want your entire portfolio to be wiped out. The second problem is that especially new traders end up taking profits way too soon. Trading is a strategy. You have losing trades, you've got winning trades, and there's a nice delicate balance between these 2 poles, losing and winning, that you always need to be cognizant of, that you always maintain some ratio that the winning trades recover more in value than what your losing trades loses. Otherwise, your profit will deteriorate over time. And by taking profits too soon, quite often you don't let the stats work out in your favor. So I'm going to show you how to avoid that too. And then lastly, very often I find traders almost artificially believing that they have all their risks covered. Yet slowly but surely, their portfolio dwindles away and they never really understand why that is the case, or they never have safety measures in place to stop that from happening. So by the time I'm done, I'm going to show you a couple of ways that we're going to be using to make sure that we balance all 3 of these risks. And like I said, the idea behind all of this would be that it gives you a sense of comfort that you know what you're doing, and even if you don't know what you're doing, that at least you're not at the mercy of the market completely. So how are we going to approach this concept of protecting your capital? Professionals really use 3 tools. One is they never risk more than a percentage of their portfolio on any one trade. The second thing is they make 110% sure of the trade dynamics to make sure that the individual trades that they put on is the best trade for that position, or that if there's a choice of positions, that they choose the one that's most beneficial to their portfolio. And then lastly, they observe religiously a maximum drawdown to their overall portfolio, which is almost like a safety net, which you'll see a little bit later on. So for the first section, I'm just going to focus on the percentage risk per trade. So what is the most appropriate percentage risk per trade? In order to explain this concept, it really is easiest to use one of the most common market analogies that you'll find everywhere. It's very easy, it's very common. People use this example quite often. And the reason they use it is it explains and it captures the anomaly that you can find in the market quite well. So what I'm going to show you now is that after all is said and done, the sweet spot of how much risk of your capital that you have to allocate to a trade roughly sits between 1% and 3%. And I'm going to show you why I'm saying that and what's the impact of going larger than that, especially for a new trading account. So the way I'm going to explain this is by playing a game. We're going to say that there's a random flipping of a coin. And the game entails that you can win whatever you place down as a bet. So if you place $1 down, that on the next flip of the coin, the results will be heads, you're going to gain $1. If you call heads and the coin lands on tails, then you lose whatever you placed on this bet. So in other words, whatever your bet is, it gets returned equally if you call the outcome correctly. Now, in order to do this, we're going to just make a couple of assumptions. The coin can only fall on either heads or tails. It cannot land on its side. In other words, neither heads or tails. And the reason being that even though there is a possibility of that happening, the probability of something like that happening is very remote. So for the purposes of this example, I'm just going to ignore it completely. And the last thing is that the coin itself doesn't have a memory intact. So in other words, it doesn't understand or doesn't remember that the last flip, whatever that result was, it has to now do something different. Every flip has equal probability of landing on either heads or tails. Now, the reason why I'm going to show you this, I'm going to jump to the conclusion, but it's quite important to just mention this here because that's what I'm going to try and show you. Remember, when I started this discussion, I said, what is the most important thing that people are afraid of? And the reality is people are afraid of losing their money when they trade. So this measure I'll show you now is a fantastic way to protect yourself from yourself and to show you that even if you lose a bunch of trades, as long as you keep this rule intact, you're actually going to survive the markets for a while. So what I'm showing you here is if you risk 1% per trade, in order for you to lose 90% of your capital, you have to call 229 trades incorrectly. So what I mean by that is you really are not a successful trader. 229 out of your trades are going wrong before you've lost 90% of your position. Now, nobody really wants to lose 90% of your position. So we're going to have measures in place to protect against that. And I'm not going to jump to conclusions, but you can just scroll to the right to see what we're going to be looking at, and it'll make sense in this third section that we're going to talk about, is there's a drawdown limit of 80% that we'll be observing. And you need to understand just for now that you have to lose 22 consecutive trades before you hit that drawdown limit. And at that point, you've lost 20% of your portfolio, not your entire value. Okay, so that's important to understand because it gives you a really good sense of comfort that you can almost afford to explore a little bit in the market and take some of the market's risks without blowing up your account. So let's look at this simulation now. Remember, the game was you can choose whatever you want to risk on a bet. You can choose, and I'm going to flick this coin 6 times. And if you get your bet correct, in other words, you choose, let's say, heads, and I flick the coin and it lands on heads. If you bet $10, you're going to be returned $10 plus the $10 of your original bet. So you're going to get double the money back. However, if you lose that bet, your $10 is wiped out. Now, in a game of heads and tails, if you have a big sample of flips, so in other words, there's a bunch of times you're going to play this game, if there's only 2 outcomes, being heads and tails, the law of large numbers will kind of ensure that roughly 50% of the time the coin will land on heads, and roughly 50% of the time the coin will land on tails. The problem, however, is that the sequence of randomness doesn't happen that conveniently. So in other words, if you only observe, let's say, these 6 trades or 6 flips, it's not entirely uncommon for heads to only pop up 2 times, and not even in sequence. In this example, it's heads, then 4 tails, and a heads again. Now imagine if you were betting very big numbers. Let's say I give you $100 and you bet $50 on the first flip. You can see that you really now start messing around a bit because now you have to call these things right in order to stay in the game. So that is kind of the same analogy that when it comes to trading. In trading, once you understand that there's some math behind it and some stats behind it, the next thing to understand is you want to be in this game as long as possible for your system and your strategy to bank these stats in your favor. So in this example, if you were to risk too much in the coin game, if I'm going to relate it to the coin game, you run the risk of being knocked out too early. And ideally, you would want to see as many of these flips as possible so that you can continue to play the game. So what I've done is I've created a risk simulation model in Excel, and I'm going to share this file for you so that you can go play around it with yourself to find your own sense of comfort, kind of just to understand and to see how these things work. So let me go show you in Excel how the risk simulation works. Okay, so what I've done is I've built this model in 2 forms. The blue blocks will be both variables are random. So in other words, it takes 1,000 flips of the coin, And with every flip, you choose randomly heads or tails. So there's no sequence, you just choose randomly heads or tails. And then the second component is the outcome. So in other words, whether it lands on heads or tail is completely random. The green box, just to compare apples with apples or compare two strategies, I said, what if we just always, out of all 1,000 flips, we always just keep guessing that the next flip will be heads. So you never change your choice of your outcome. You always say heads, and then randomly the outcome will be heads or tails. Now remember, every time it lands on your outcome that you correctly predicted, you get double your money. If you lose whatever you've placed on bet. So let's stick with this blue box, which just says both variables are random. And I want to show you something. If I say let's risk 1% of our capital in variable 1, and the second graph, which is the one on the right, let's make that 3%. I just want to show you something quickly. And I'm going to run this a couple of times. Now remember, just for a second, every time I press this button, it runs the flip 1,000 times. So in other words, 1,000 random flips of the coin. Now what you want to be looking out for is look at the graph on the left, variable 1. And you'll see, relatively speaking, it has a far smoother line. Whether it goes up or down is not relevant. What I'm showing you is the smoothness of that line. It really remains relatively smooth. And what I'm saying is, look at this example. When you're hedging, when you're using 3% as a bet, can you see these wild spikes? Look at that one. Now I can run this simulation over and over and over and over, and you'll see every time that I do this, the 1% remains fairly stable. But more importantly, what I want you to see is it keeps you in the game for 1,000 flips. Hardly ever. I mean, the chances would be that you might wipe out, but look at this. I'm going to just keep pressing the button, and every time I do, you'll see that the game, or by risking 1%, so far you've seen 1,000 flips 10 times over. So that's 10,000 flips, and you've always been in the game. Now, what people often forget is they get brave, and as they start winning, they increase the variable quite a bit. So let me show you what happens when you risk 5% of your portfolio. So look at this. Again, on the 1%, it's fairly stable. Look at these peaks and troughs on the 5%. And all of a sudden, you can see that if I run this a couple of times, that the chances are you're now no longer so certain that you're going to actually be in the game for the 1,000 flips. Look at this one. Practically flatlined all the way there after 600 flips. And this looks worse. If I make that 10%, this looks really ridiculous. Look at that. Out of the 10 times, or the 10%, most of the time, you're really not sure if you're going to see 1,000 flips. Now, the point here, remember, is that we're not in the game to predict right from wrong. We're in the game to stay in the game. So we want to make sure that we see 1,000 flips, because then we can fine-tune our system to trade, or for the trade results to improve. So in summary, this risk-reward situation is going to work in our favor. And remember, from the first slide, it's only one of 3 risk mitigants that will continuously apply. But what I wanted to show you is you can really have a sense of comfort knowing that as long as you risk 1% of your portfolio and you ensure the other 2 variables which we will discuss in the next sections are being adhered to, you can actually afford to trade, because the chances of you losing all your money becomes far, far less. Now, the purpose of me telling you that, or emphasizing that is the biggest risk that people face. They don't want to lose their money. So if I've just told you that, listen, there's a way that you can start trading without the risk of losing your money, surely that should make you feel a little bit better. It'll make you emotionally a little bit stronger to trade or to start trading. And more importantly, if you know that you're going to be trading for the long term, you'd really get detached from any one single result of any one single flip. And that's what's most important to me. So in summary, I just want to show you that you really shouldn't be risking more than, let's say, 1 to 1.5% of your capital per trade, which I believe is the sweet spot. There will be times that we're going to change that rule, but for purposes of this example, let's just stick with that. All right, so that was a quick intro just to show you how important it is to manage the right exposure, or the size of the exposure. I invite you to now look at the other 2 components which we will be addressing in the next videos. All right, thank you very much, and I'll chat to you soon.